The U.S. tech sector is showing cracks, real cracks, and they're forming faster than anyone expected. For more than a decade, tech has carried the American economy. Jobs, innovation, profits, stock market growth, everything. But now, growth is slowing. Layoffs are accelerating. Investment is cooling. And if this pillar falls, the impact won't stay in Silicon Valley. It will spread to the job market, the markets, the consumer, and the entire economic system. Today, we're asking the one question almost no one wants to confront. What happens if the tech sector breaks? The first signs of a real breakdown in the tech sector are already here, and they're becoming harder to ignore. After years of rapid expansion, the industry is hitting a wall on multiple fronts, and the slowdown is spreading far beyond Silicon Valley. Tech layoffs, which many believed had peaked last year, are accelerating again. Companies across software, e-commerce, fintech, and even cloud services are cutting staff to preserve cash and maintain profitability. These aren't just struggling startups. Large, well-established firms are quietly winding down projects, freezing hiring, and reducing headcount for the second or third time in less than 2 years. At the same time, revenue growth is slowing across key segments. Cloud spending has decelerated, PC and smartphone shipments have yet to fully recover, and digital advertising growth, once the engine of big tech, is losing momentum as businesses pull back on marketing budgets. Venture capital funding has collapsed to multi-year lows, leaving early-stage companies starved for liquidity and forcing many to shut down or merge under pressure. Even within the highly celebrated AI sector, the cracks are visible. Costs are skyrocketing, demand is uneven, and many companies are finding it harder to justify massive investments without a clear path to profitability. Behind the scenes, major tech firms are slowing capital expenditures, signaling uncertainty about how strong future demand will truly be. Individually, these issues might seem manageable, but together, they show an industry losing stability, and when the tech sector weakens, the rest of the economy feels it soon after. If the warning signs weren't enough, the data now paints an even clearer picture. The tech sector is slowing in ways we haven't seen in over a decade. And the numbers reveal a pattern that's far more serious than a typical business cycle. Revenue growth for major tech companies has decelerated sharply. Cloud computing, once the most reliable engine of expansion, has seen year-over-year growth fall from double digits to single digits. Enterprise clients are delaying upgrades, cutting software subscriptions, and reducing cloud workloads to save money. When businesses tighten budgets, tech feels it immediately. Consumer hardware tells a similar story. Smartphone shipments remain well below pre-pandemic levels. PC sales are still struggling despite aggressive discounts. Even wearables, one of the fastest-growing categories just a few years ago, are seeing demand cool. Consumers are simply not upgrading like they used to, especially as household budgets come under pressure. On the financial side, tech companies are experiencing margin compression. High interest rates have pushed up borrowing costs, supply chain expenses remain elevated, and wages in the sector, even with layoffs, are still historically high. As a result, profit margins have tightened, prompting executives to scale back on hiring, marketing, and research spending. Venture capital data may be the most concerning of all. Funding for early-stage tech startups has dropped dramatically, falling to its lowest levels in years. This is critical because startups drive innovation, talent, mobility, and future job creation. Without funding, the next generation of tech growth simply won't materialize. Taken together, these metrics show an industry under stress on nearly every front: revenue, demand, margins, investment, and consumer behavior. And if this pressure continues, the tech sector may not just be slowing, it could be heading toward a structural reset with far-reaching consequences. The reason a weakening tech sector is so dangerous is simple. Tech isn't just another industry. For the past 2 decades, it has become the backbone of the U.S. economy, driving innovation, job creation, productivity, and stock market performance. When tech slows down, it doesn't just affect tech workers, it affects the entire system. First, tech carries an outsized weight in financial markets. A small group of major tech companies account for a massive share of the S&P 500's total value. Their earnings influence investor sentiment, market stability, and household wealth. When tech stocks fall, retirement accounts shrink, the wealth effect disappears, and consumer confidence drops. A decline in tech valuations is not contained, it sends shockwaves through the entire market. Second, tech is a major employer, both directly and indirectly. Beyond the core engineering and product roles, the industry supports millions of jobs in marketing, logistics, customer service, contracting, and regional economies. When tech companies cut hiring or reduce staff, those effects ripple outward. Layoffs in Silicon Valley, Seattle, Austin, and New York don't stay local, they drag down housing markets, restaurants, transportation services, and local tax revenues. Third, tech drives corporate investment and innovation cycles. Over the last decade, businesses in nearly every sector have increased spending on cloud computing, software, automation, and AI. When tech companies scale back their ambitions or reduce research budgets, the innovation pipeline slows. That means fewer breakthroughs, slower productivity growth, and a weaker foundation for future economic expansion. Fourth, the AI boom, the biggest growth story in tech, is already showing signs of strain. Training AI models is becoming exponentially more expensive, and demand for AI services is proving uneven. Many companies rushed into AI spending without a clear monetization strategy. If AI investment cools, the entire narrative supporting tech's next decade of growth becomes uncertain. And when expectations fall, valuations follow. Fifth, tech is highly sensitive to interest rates. High borrowing costs hit this sector harder than most others. Growth-oriented companies rely on future earnings, long-term investments, and the promise of scaling. But when interest rates stay elevated, capital becomes more expensive, risk tolerance collapses, and investors demand immediate profitability. This environment suffocates innovation and squeezes companies that depend on aggressive forward spending. In short, the tech sector sits at the center of the modern American economy. If it weakens, jobs weaken, markets weaken, investment weakens, and confidence weakens. The system becomes exposed, and the economy becomes vulnerable in ways that are far more widespread than most people realize. That's why the cracks forming in tech today are not just a story about Silicon Valley. They are the early signs of a potential chain reaction that could spread through the entire economic system. If the tech sector continues to weaken, the consequences won't stay contained to Silicon Valley. A true break in tech would trigger a chain reaction flowing through every layer of the U.S. economy, and the sequence is more interconnected than most people realize. The first stage is job market instability. Tech layoffs have an outsized impact because these jobs are high-paying, concentrated, and tied to regional ecosystems. When thousands of engineers, designers, marketers, and contractors lose their jobs, it immediately reduces consumer spending in their communities. Housing demand softens, restaurants lose traffic, small businesses feel the squeeze, and local economies begin to contract. The second stage is a collapse in corporate confidence. When tech, the sector that's supposed to be America's future, starts cutting back, other industries take notice. Companies across retail, finance, logistics, and manufacturing begin preparing for a downturn. They freeze hiring, delay investments, and scale back projects. This widespread caution slows economic momentum long before a recession is officially declared. The third stage is a tightening credit environment. Banks and lenders watch tech very closely because of its market influence. If valuations fall or earnings weaken, lenders become more conservative. Startups lose access to funding, small businesses struggle to renew credit lines, and mid-sized companies find it harder to borrow for expansion or innovation. Credit stress spreads quickly, and once credit tightens, growth slows across the entire economy. The fourth stage is market instability. Because major tech companies dominate stock indexes, a decline in tech stocks pulls the entire market down with them. This erases household wealth, weakens retirement accounts, and triggers the negative wealth effect, where people spend less because they feel poorer. Markets don't just reflect confidence, they shape it. The final stage is a consumer pullback. As the job market softens, credit tightens, and markets turn volatile, consumers reduce spending. Lower spending hits corporate revenue, which leads to more layoffs, more caution, and more instability. This is the chain reaction. Tech weakens, markets weaken, credit weakens, jobs weaken, consumers weaken, everything weakens. Once this loop begins, it's extremely hard to stop. The cracks forming in the tech sector aren't just another slowdown. They're a signal, a warning that one of the most important pillars of the U.S. economy is starting to lose momentum. When tech weakens, the effects echo far beyond Silicon Valley. Markets react, credit tightens, jobs disappear, confidence breaks, and once confidence breaks, every other weakness in the system becomes harder to contain. The truth is simple. Tech doesn't have to collapse for the economy to feel the impact. It only has to slow down, and the data already shows that slowdown is happening faster than expected. Growth is cooling, investment is shrinking, costs are rising, and the industry that once drove innovation, productivity, and wealth creation is now becoming a source of systemic stress. The next few months will tell us whether this is a temporary softening or the beginning of a larger structural reset. But here's the part almost no one is talking about. If tech keeps weakening, the next sector to feel the pressure won't be finance or manufacturing. It will be the housing market, the place where high rates, falling confidence, and job instability collide. And that will be the focus of our next video.